class home assignment நிறைய இருக்கு.
So Hari, if you complete one assignment, I'll take it. If you complete one assignment, okay, I'll get a job. वो assignment complete है, मैं party के साथ लेके.
Party के घर इप्पो मुड़ियादे.
अम्मा, if he completes, just let it be. If he completes 2 assignments on his phone, then I can take him to party space. If he doesn't, then
எனக்கு முடிக்கணும் assignment நாளைக்கு due. This promise. Assignments முடிச்சிட்டு போ. நாளைக்கு போ Saturday.
If you completed assignments,
நாளைக்கு Saturday தானே? நாளைக்கு போலாமா இல்லையா?
हरी जाके करो तुम assignment.
कितने assignments है?
मैं देती हूँ सब एक-एक करके निकाल के. मेरा अपनी क्लास में.
You will do them one by one. अम्मा पहले
करके देखो. पूछी थी तुम आए नहीं. मेरे को अभी क्लास है.
ये 2-3 कर रहा हूँ.
Just give him the assignment.
I'm having a class. मुझे नहीं.
अम्मा कौन सा? When we saw balance of payment, we said FDI is also an equity investment, long-term investment in equity shares. One country's company can invest into another country's company for over 5 years in its equity share as a partner, joint venture, merger, collaborator, etc. And it is over 5 years till perpetual existence. Also that it enjoys a controlling share in the assets of the company, profits of the company. FDI capital brings in not only monetary capital, but also technical know-how. Capital, but also technical know-how. So, management strategies, everything along with the monetary capital is got inside the company, and this is a very good source of capital or inflow of capital for a nation, because it brings in economic, it will help in economic planning. So these were some of the equity instruments. FPI was a short-term investment into any other companies, any other countries company, and then FPI is a short term in the sense it could even last only for a day, like morning they invest, evening if they have profit they will book their profits and exit the market. It brings in economic shock and it also gives rise to outflow. So these were some of the equity capital apart from ADR, GDR. They were also an equity source of investment. Now talking about Euro issues. What are Euro issues? Investing in a country's, country or investing in an instrument which is denominated in another currency than that of the domestic currency where the land you are issuing. Like for example, if I'm floating a bond which is denominated in US dollar in India, then we call it as a Euro issue. If I borrow a loan in India, but the currency is Singapore dollar, it is again a Euro loan. Are you following this? That is about Euro loan. Now let's talk about some quasi instrument, partly equity and partly debt. Right? Quasi instruments are foreign currency convertible bonds. I'll just remove this annotation for a minute. Are you able to understand? Are you understanding this? I'm removing all these annotations. We saw about equity instruments, and then before passing on to debt instruments, we are talking about partly debt and partly equity. partly debt and partly equity in the sense warrant is an example where there are the investor is issued with share warrant, and this warrant is remaining as debt instrument for some time, say about 10 years, 15 years. After 15 years, if the investor wishes, he can convert it to equity shares, right? They call it as ordinary share. And then foreign currency convertible bond is an international instrument issued to the non-resident of a country and in foreign currency. Now what happens is these are all listed in European Stock Exchange, and also that these are issued as bonds and as debt instruments and are listed in European Stock Exchange. Now, when the investor wants, he can convert it to the same country's equity shares. So now the warrant is making you eligible to buy the equity share at a lesser price, discounted price than the market price. Now we come to debt instrument. We saw about equity instrument and then quasi instruments and now debt instruments. One of the most important, we will just have a summary of what instruments that we will be seeing when we see about debt instruments, right? Under debt instrument, we'll have debt instruments. We have syndicated loan. Euro bonds, and then foreign bonds. These three are very, very important instruments, and we will be seeing one after the other, right? Now, when I say debt instruments, syndicated loans is an important instrument. Now, what happens is, this was introduced in India when the size of loans increase. Like for example, if companies want loans in say millions, if they want $1 million, like for example, company wants to raise some 10,000 crores of rupees, and if a particular bank or say particular bank is not able to finance this, it is going to syndicate the loan in the sense that it is going to call for many other banks to lend this loan. If there are smaller number of banks involved in this, we call them as club loans. But if there are larger number of loans, it is called as syndicated loans. And when syndicated loan lending takes place, it is usually through a merchant banker. We will see the process, but then the advantage of syndicated loan is, number one, the bank does not lose its opportunity to lend to such a big client who needs a huge amount as loan. Secondly, it also spreads the risk. If one bank lends and if the loan turns bad, the entire bank is going to collapse. But then this process can be avoided because the risk here is spread among all those who are participating here. Each of them share the risk and each of them are going to be lending in part. So even fund shortage can be addressed. To understand what was told, can you please type your responses in the chat box? When I have more than 3 or 4 banks participating in the lending, it's actually usually some 50-60 banks come together to lend, because lending opportunity is not lost. At the same time, the risk is being shared by all the banks. Also, funding is also shared by all these banks involved. So it usually happens through a merchant banker. So how does this happen? For example, a party approaches, say let's take an example of infrastructure project. For infrastructure projects like flyovers or metro constructions, they would require large amount of funding. So when they require large amount of funding, what will happen here? They will have to, the concerned party or the concerned company, if it is Reliance Infrastructure, it approaches a particular bank, say it approaches Canara Bank or it approaches say HDFC Bank for funding. Now HDFC Bank wants to lend, at the same time it doesn't have so much of money. So what it will do, it will talk to a merchant banker. We call them here also as lead managers. And they, I mean, in foreign, they are synonymously called as investment banker. So Morgan Stanley, Merrill Lynch is no more. So I'm not talking about it here. Morgan Stanley, or they will go to any other merchant banker and they will speak about this. The bank is sending the proposal. It says, I want to lend here, but then I want more number of banks to participate because I am running out of fund. I may not have so much funding, or I want more banks to participate. So now what happens here is the merchant banker is calling for bids from all other banks. Now what happens, bids in the sense, what are the terms and conditions of each and every lending party? If you are interested, you will have to quote your terms and conditions. Like terms and conditions includes what is the rate at which you want to lend, what is the amount that you want to lend, and what are your terms and conditions to treat the loan as NPA, and by when, how often should it be paid, etc. Like service, say every month I need to receive so much of interest and so much of principal, etc. All these things. That is called as debt servicing. When you pay interest and EMI, when you do this EMI payment, we call it as debt servicing, right? So all these things are done. Now what happens is syndicated loan can be arranged very quickly if the company is very, very reputed. Now fees payable is also discussed. Fees payable to the lead manager is called as commitment fee. And now what happens, management fee. And there is an underwriter appointed. What is the job of this underwriter? Underwriter is going to finance that portion of the unsubscribed loan. Like it has invited for 10,000 crores rupees and 8,000 crores have been arranged for. Underwriter who is appointed is responsible to pay the 2,000 crore rupees for the loan. That because this part has not been arranged, and that is the job of the underwriter. But in case the lead manager arranges all the loans, do you understand? I mean, entire 10,000 crores, underwriter only gets his fees because he just has committed. In case it is unsubscribed, I will subscribe for it. Else, I will charge only my fees, right? Now, apart from that, there is an agency fee wherein any administration costs incurred, there will be an agent bank who will be appointed to take care of all these in between administration work. So it also costs a lot. So now what happens is during syndication of loans, they receive bids from a lot of banks. They are called as participating banks. And these participating banks will tell in a confidential bid, that is called as bid. They will write in writing, they will mention, I would want to sponsor so much, I would be charging so much interest, these are my terms and conditions. So when borrowers and lenders sit across the table and negotiate on these things, bids are all selected. And all those bids which they feel is feasible is selected. And when it is selected, they are going to be called as participating bank, and each and every participating bank gets its own fees. So now what happens, as I told you, very, very advantageous circumstances that they have the size, the currency is decided, the terms and conditions are decided, and then the terms and conditions are decided, and also the cost is decided. Now, therefore, what happens here is the entire loan has been sourced. Entire loan is sourced by some participants. Okay, just a second. I'm sorry, yeah. So when the loan is arranged, what happens is it is done on a best effort basis or an underwriting basis. Did you understand what syndication of loan is? I will tell you in simple terms, wherein the size of the loan is very large and one or two single banks cannot arrange for this loan. And therefore, what will happen? They are going to arrange for a few banks. So a lead manager is appointed who is going to invite bids from other banks. When he invites bids from other banks, the participator, the lender and the borrower sit across the table and negotiate. So when the lender, borrower, underwriter and all other agent banks are all going to sit here, they are going to negotiate on the terms of loan, currency in which the loan is, repayment terms and conditions, and tenure of the loan. All these are discussed across the table. And this syndication is done on a best of effort basis, which means underwriting basis. So lead manager also sometimes syndicates all the loans. Apart from that, which means syndicates in the sense he makes the group of banks or financial institutions to make the lending. He arranges for the thing. Advantage here is it is very easy to arrange. It is a speedy process and 100% certainty of funds, because even if banks are not able to lend, it is underwriter who is going to lend the remaining portion. And also maturity profile of the loan is much transparent. Things are very transparent here. Everything is published, everything is in black and white, etc. Repayment is very flexible. Cost is lower comparatively because they are all negotiated. A lot of competition is there, so banks will try to charge a lesser amount. And also currency is diverse. You have variety of options in the currency of loans also. And apart from that, there is also relationship built between the borrower and a number of banks here with the help of lead manager. So what are the steps in syndicating a loan? Now the borrower decides the size and currency of the loan he wants to borrow. And he approaches banks for arranging the finance on basis of business purpose of the loan, etc. Right? So once that is decided, as I told you, he's going to approach his bank and he's going to talk to them why he wants the loan. He submits a return proposal, etc. Now, if the borrower is reputed enough and if the borrower is reliable enough and if the purpose is going to be for a very big purpose for which he is asking, the banks will offer it to be a lead manager. The bank will say, I will take up the lead. I will ask banks to participate. And then the interest rate would be based on LIBOR, London Interbank Offered Rates, centralized PLR system. Remember, I told you about what PLR is, prime lending rate, which is applicable in India. See, the RBI fixes this rate. It is the rate, a minimum rate chargeable to a customer who comes to borrow loans from you. And this rate, you can have a markup rate over this. Supposing PLR at the moment is say 7%. Any bank should lend at 7% as minimum. It's just an example, right? 7%. And depending on the type of customer, supposing I have a customer coming to me for infra project. So I will say PLR plus say 50 BPs. BPs is a technical term called as basis points. Basis points. Every 100 BP equal to 1%. Therefore, if PLR is 6%, you will be lending to this particular customer at 6.5%. Are you following this? I will be lending at 6.5%. So this is called as PLR is called as benchmark rate, and plus whatever I do is called as markup rate. Same way at a global level, we are going to talk in terms of LIBOR, London Interbank Offered Rates. And if London Interbank offered rates. I want to talk to you about how it is calculated in the next class, right? When we learn about bonds and finish that part of it, I will tell you how it is calculated. And borrower now chooses the bid which appears to be best to him. Because I told you the lead manager is going to invite bids in return form. Bids in terms of the amount of the total cost and the amount the bank is willing to finance, and this is from all financial institutions. If it is going to be 200 banks which are coming forward, each bank, how much are they contributing as finance? What are their terms and conditions, etc. Right? So once these are going to be, and borrower chooses those bids that he feels is going to be feasible to him. So now, and also the tenure for which they are going to be borrowing. Now, once the loan gets finalized, both the borrowers and lenders are going to have an information memorandum which gives the financial details of the borrower, right? And then the other details of the borrower, financial and other details of the borrower, and lead manager would participate in the loan from lenders based on the information memorandum, right? Now, after that, fees shown by fees would be shown by all the participating banks. I told you participating banks also get a fee earlier. So this will also be negotiated. Lead manager will act as an underwriter. He has to finance whatever is left out. As I said, it is done on best effort basis, which means underwriting basis. In case 1,000 crores, I have only 9,900, I'm sorry, 990 crores, 10 crores will be financed by the lead manager. And finally, the loan is finalized and then an agreement is made between the borrower and lender. And this is published across. These are the participants, this is the amount of loan, this is the cost of loan, everything is published. So these are the steps in syndicating a loan. Now we'll see what are the provisions of a loan agreement. The loan agreement, when they are drafting, specifies about the interest rate, commitment fees. Commitment fees is for the lead manager who is going to arrange. He has committed, right? So he will get the commitment fees and the management fees. Commitment fees is paid for underwriting. Management fees is made for managing the loan. Borrower should pay to the lender, right? And all documents pertaining to the borrower and collateral and tax related documents, everything should be produced. And all certificates from the lawyer, whatever is required, both internal and external approval would be required. And any kind of primary and, as I said, collateral will have to be decided. Whatever security is required for the loan to be financed, that also will be decided. And what circumstances under which the loan should be treated as default, that also should be decided. And all these are brought under the loan agreement. And what will happen if there is a default? What jurisdiction, which country's law should be applied and sue against the borrower in case he fails to repay. So all these are discussed under the loan agreement. Now we'll talk about the advantages of loan syndication. What are the advantages of syndicated